While France and Germany slipped into contraction, the UK economy did something no one expected. April's flash composite PMI came in at 52.0, against forecasts of 49.8. Manufacturing hit 53.6, a level not seen since May 2022. Services held at 52.0. Every number beat, every single one. The FTSE 100 still fell. That is the first thing worth noting. Headlines from Reuters read, FTSE 100 retreats as oil climbs higher, and the index closed off 0.77% at 10,395. Crude above 100, and Hormuz tensions dominated the mood. And yet, underneath the surface, the UK economy was printing data that told a completely different story from its European neighbors. France's services PMI collapsed to 46.5, 14-month lows. Germany's services sector contracted for the first time in 11 months. The Eurozone composite fell to 48.6, the first recessionary reading since late 2024. The continent moved one way. Britain moved the other. Sterling briefly recovered losses, stabilizing near 1.3500 against the dollar after the numbers landed. The gilt yield edged higher to 4.92.
Chris Williamson, chief business economist at S&P Global Market Intelligence, offered a careful warning alongside the strong PMI numbers. The upturn comes with a catch, he wrote. The improved rate of expansion is in part a reflection of a short-term boost from a rush to secure purchases ahead of feared price rises and supply shortages linked to the war. This is the mechanism that explains the divergence. The Eurozone froze. Businesses pulled back in the face of the Hormuz closure. Britain, at least in part, did the opposite. Procurement managers accelerated orders. Companies bought forward. The same supply shock that caused confidence to crater on the continent created a brief surge in activity on this side of the channel. That distinction matters enormously. A genuine acceleration in demand is durable. A preemptive stockpile is not. It borrows growth from future months and leaves the underlying picture unchanged or worse. The UK's manufacturing PMI at 53.6 looks extraordinary. But if that reading reflects businesses rushing to secure inputs before shortages bite, then May's figure could reverse sharply once the front-loading fades. There is a second complication. The borrowing figures that briefly cheered Chancellor Rachel Reeves came with an immediate asterisk. Capital Economics said the energy price shock means government borrowing will overshoot OBR forecasts by £29 billion for the 2026-27 fiscal year. Inheritance tax receipts hit an all-time high of £8.5 billion, a sign of revenue pressure on households, not a sign of wealth. Elliot Jordan Doak at Pantheon Economics calculated that the government already faces roughly £12 billion in additional interest payments this year, before any household energy support is offered. FTSE 100 banks are heading into earnings season next week, with combined pre-tax profits expected near £16 billion, but analysts at AJ Bell pointed directly at rising loan impairment charges as the risk that limits headline growth. Barclays reports Tuesday, Lloyds on Wednesday. Provisions for bad loans are forecast at £2.6 billion across the Big Five, the highest first-quarter charge since early 2020. NWH Smith, the travel retailer built around airports and rail stations, suspended its dividend entirely. Profit before tax fell 85% against last year. Net debt rose to £496 million. Analysts at Panmure Liberum noted that up to 99% of full-year profit now depends on the next 6 months of peak summer trading, a summer where the Hormuz blockade is cutting flight capacity, and the IEA warns Europe has 6 weeks of jet fuel supply remaining. The UK's PMI beat is real. The question is whether the activity it measured was strength or a last sprint before the supply wall arrives.
The last time the UK and Eurozone diverged this sharply on PMI was during the peak Brexit uncertainty of 2019, when UK manufacturers front-loaded orders ahead of potential trade disruption. That episode produced a brief PMI spike, followed by a sharp reversal once the deadline passed and the stockpile effect wore off. The economic reality reasserted itself within 2 quarters. The parallel is not exact. Brexit was a domestic supply chain event with a clear calendar. The Hormuz closure is an external energy shock with no confirmed end date. There is no equivalent of an Article 50 extension to negotiate. Trump's ceasefire extension was confirmed at 3 to 5 days. Iran has stated it has no plans to negotiate. The U.S. Armed Services Committee briefed that clearing the Strait of Hormuz of mines could take up to 6 months.
The case for the UK PMI beat being meaningful rests on two conditions. First, that UK services, less energy-intensive than manufacturing, hold up even as that the Bank of England keeps rates on hold long enough for business activity to stabilize without a credit squeeze. If services stay above 50 in May and June, the PMI story has legs. The case for reversal is straightforward. Front-loading fades, jet fuel costs kill summer travel volumes, WH Smith is the early warning rather than the exception, and the bank earnings next week reveal loan provisions rising faster than net interest income. If May's PMI prints below 50, particularly on services, then April's reading will be recategorized stage credit deterioration, regardless of what the PMI said today. The numbers today moved in Britain's favor. Whether the next set of numbers confirms that or explains it away is what the market will spend the next 7 days finding out.